Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Reema and Nigel. Guys, good morning.
Morning.
Hi, good morning. It's the start to the very important week. 4 days to go for the budget on Sunday. And we've got the India-EU deal to talk about, lots of earnings, and 2 monthly expiries this week.
Well, that's right. A start of a very important week and the end of a rather dull monthly. Because in January itself, we're down 850 points. So starting of 2026 on the back foot, but we live in hope. I'm wondering how to read these headlines now with regard to tariffs, right? He's going after Korea. Some positive commentary over the weekend. Live in hope.
Live in hope, but I mean, January has been, it just felt like 100 days, no?
Yeah.
I mean, it's just, I think it's 20 days, but it feels like 100. And just amazing, the amount of news flow which has come our way. And it's also obviously, you know, what to make of it, how much importance to assign to it, how should prices react. I mean, it's all been really mind-boggling in that sense. Let's just take it from the top, right, in terms of what you need to know. So I'll start with the latest, and markets, of course, always look ahead. So looking ahead, today you have the EU-India FTA announcement. Basically, the announcement is going to be the closure of negotiations. The negotiations ended yesterday. Today, they're going to be basically signing a document which signifies the closure of negotiations. But the FTA itself, and there has been a fair bit of confusion, as we noted online, on social, etc. The FTA itself is only likely to be operative from early January, sometime in early 2027. Because after the closure of agreement is signed today, you will need, the legal vetting, etc., what has been agreed with India to be translated into all these languages, sent to respective parliaments in European countries. And, you know, those parliaments have to approve, and only then, I mean, all that will take time through the course of this year, and operationalization only early next year. But mind you, even as that may be, EU is the single largest sort of trading partner for India. 17% of India's total exports to EU, that region. So I think, I mean, it's not small in terms of implications. And I think this is significant, especially in the geopolitical context we are in. You know, there was some comments from Scott Bessent, and it really tells you the kind of situation we're in. This is the US Treasury Secretary saying, essentially commenting on the fact that they've imposed tariffs on India, for 25% penal tariffs on India, and EU is because India is buying Russian oil and Russia is fighting Ukraine, Europe is supporting Ukraine, and Europe is signing a deal with India. So, I mean, you know, this is coming from the US Treasury Secretary. That's the kind of environment we're in. For us, in a direct kind of a way, he had this to say, and these are comments from last Friday. He said, well, because Indian imports of Russian oil have come down substantially, the exact quote was, and it's on your screen, I would imagine there is a path to take them off, the 25% penal tariffs. And I think perhaps now it starts to go away. Now, in terms of the EU-India, I think the one specific sector is the automobile sector. Now, exports, of course, it's great, positive news, textiles and so on and so forth. But the auto sector is where, because European cars become cheaper, how much cheaper, etc., we will need to see. But we will need to watch the impact on autos where imported cars out of Europe become cheaper. And I think that is something we will discuss in greater detail as we go along. There is a FOMC meeting this week. So no changes expected. Most likely they will leave rates unchanged. The bigger announcement, of course, is the Fed chair. Who's going to be the Fed chair? And that announcement is likely this week as well. It's like a two-horse race. There is Rick Ryder and Kevin Warsh, and markets would likely be okay with both. And you know, both would have obviously promised to keep their strategies differ in terms of what they would like to do. One wants greater control of the Fed balance sheet, that is Ryder. Warsh wants lesser use of the balance sheet, but outright lower rates. But the ultimate aim, of course, is for the US government to lower its interest expenses, and it'll be interesting to see who really gets the job. But I think it's an important one, nevertheless. Last two sessions, because we're coming out of a holiday, so Friday session and Monday session, S&P 0.5 higher, NASDAQ 0.75%, dollar index down about 0.5%. And by the way, I mean, this is the thing, right? The dollar has been weak and how, especially in yesterday's session, across the board, not just against the major currencies, but against emerging currencies. Yen saw that large move. I mean, the Korean won saw a large move. Not just against majors, but emerging Asian currencies as well. And I say this specifically in the context, of course, of India, where the rupee hit a record low, 91.94 on Friday, and it was like a waterfall move, and we are, of course, within striking distance of 92. So you've got a situation where, emerging market currencies are all doing well. They're at actually intra-year highs. And you've got the rupee, which is an all-time low. So very, very stark and clear difference in that sense. But will we get some reprieve today? I think that's the question, because dollar has been uniformly weak in the last 24 hours or so. Now, just a couple other things. Silver hit $117. Spot silver hit $117 yesterday, last night. And I think we're at about 110 or so now. But big moves. Gold, of course, now beyond 5,100 for the first time, of course. Absolutely stunning kind of moves. Now, I'll just tie in the levels here. The last week was, of course, again, disappointing. Nifty was down 2.5–3%. This as emerging market indices were up about 1% on an average. 20 weekly moving average for the Nifty is 25,659. I think, and by the way, the 40-day exponential moving average is above the 20 weekly, 25,767. And I think this is the level which the Nifty needs to come back above for some confidence to come back. And we'll see if that happens. And of course, for the Nifty Bank, we are below the 20-day moving average, which is 59,506. I don't think there is any confusion about what the market and the indices need to do, which is cross these 20-day for the Nifty Bank and the 40-day exponential moving average for the Nifty for people to start believing that maybe, the worst is kind of behind us. I'll just say this. There are 4 days to go for the union budget. The GIFT Nifty will come up on your screen. 4 days, right? The FII shots in index futures, if you look up the value, it's about 38,000 crores. It's at an all-time high. Not even during COVID we had such high shots. So will FPIs go into a budget kind of an event, which is on a Sunday when markets are trading with such large shorts, or is there room for some amount of buoyancy, some covering, etc., into the next few trading sessions? The news flow aside, and the news flow, by the way, in the last 24 hours, 48 hours, is positive. So I think I'll just leave you with that thought. 100-point higher start on the GIFT Nifty is where we're at. But a little bit more in terms of deep dive into the futures and options segment. Nigel is standing by with the positioning and other data. Nigel, over to you.
Well, the GIFT Nifty is suggesting a big gap up, and it'll be interesting to see whether or not that gets sold into, because that's been the trend of the last few trading sessions. But this week, in fact, this weekend, we had a lot of cues that's coming in there. Trump has gone ahead, increased tariffs on Korea. Is that a blessing in disguise? Because a lot of money was going to other markets, like Korea, Taiwan as well. We have been holding our own with regard to the tariffs. So could this be a blessing in disguise because of the flip-flop that Mr. Trump is doing? US Treasury Secretary as well said that there is a part to take off the 25% Russian oil tariffs, which is encouraging as well. And the oil important monthly expiry plays out today. And the Nifty is already down 800 points in the first series of 2026. The problem is the VIX. That was at bombed out levels, holding at around 10, 11 odd. Now, in the last few days, just take a look at the move out there. From around 10, it's moved to around 14. I'll tell you what, till it gets to around 16, 17% odd, the bulls will still be pretty much okay. But that fear index is moving up. So that 17, 18% mark is the one that you're looking at, because that indicates heightened fear. The FI selling, well, that continued, but that was cancelled out by the DII buying. So net institutions, more or less a flattish number. But the FIs, they added close to 2 short positions for every 1 long position. So 22,000 contracts is what they added on the short side, and around 11,000 contracts on the long side. The problem now, here's where the problem is, because the shorts are down, but still there is no short covering bounce that we were hoping for. Because the Nifty is down close to around 500 points, while you have the short positioning as well. In percentage terms, that's come down from around 91% to around 85%. In absolute terms, it's more than 2.2 lakh contracts on the short side. But there are signs that, in fact, those short positioning that you wanted to come down, that's come down, but that short covering bounce remains elusive. However, with the short positions of the FIs at around more than 2 lakh contracts, the technical indicators as well at extreme levels, whether you're looking at the PCR, whether you're looking at the RSI, both of them are indicating oversold levels. So the hope is FI shorts, at extreme levels as well as the PCR and RSI, you're hoping that at least in the near term, the recent low gets protected. Because the 25,100 call, 25,200 call, both of them very aggressively written in Friday's trading session. Which brings us to the levels. Friday's high becomes important, 25,350. That'll be the near-term resistance that we're looking at, while the recent low of around 24,900, that's going to be important to defend on the downside. The Nifty bank, that was holding its own, but the last few trading sessions, that's underperformed. It's broken the 20 DMA, it's broken the 50 DMA as well, and now the hope is that we don't see a further correction, because if that has to go ahead and visit the 100 DMA, then that's a bit of an issue. Currently trading below both the 20 as well as the 50 DMA. The 100 DMA comes in at around 57,750. The rupee, that needs to stabilize. You don't want this market to rise, but if it can, the index can just consolidate. Even if the rupee can pull back a little bit more, well, that's going to be a very, very important indicator. So I'll keep an eye out on some kind of stability on the rupee, and the index as well seeing some kind of consolidation from these levels.
All right, thank you very much for that. And just to give let's tell our viewers all the interactions that we've lined up on the show today. Coming up at 8:35, we've got the management of Gokuldas Exports to discuss about the potential tailwinds from the India-EU trade deal. At 9 a.m., we'll be joined by Digant Haria of Green Edge Wealth to discuss the banking numbers over the weekend. 9:20, Dheeraj Agarwal of Ambit Investment Managers will be the market master for the day. 9:30 a.m., more management. The management of Sona BLW will talk about the December quarter numbers. Following that, the management of JSW Steel will chat with us at 9:40 to talk about Q3 and the way forward. And then Granules India will speak with us again, talking about the F5 Q3 outlook. Towards the end of the show, Lata will discuss the capital gains tax in the upcoming budget with 3 experts. All right, just to give an indication of how the markets seem to be reacting to Trump tariff headlines, look at the Korean market. Kospi is now up 1.5%. Remember, Trump threatened to hike tariffs in South Korea from 15% to 25%. The reason was a delay in South Korean legislature in approving the deal. And, this was a deal, which was reached in July 2025. The terms were reaffirmed in October of last year. But because the Korean legislature has not approved it, Trump has threatened to further increase the tariffs from 15 to 25%. But markets unruffled. Initially, the Korean markets opened lower. You had automakers like Hyundai, etc., down nearly 4-5%. But now, Kospi is up 1.5%. Hyundai is up close to about 0.5%. So markets, in a way, are not reacting too much to the headlines coming out on the tariff front. But it's been a tough 2026 for the Indian market. The Nifty is down 4% since the start of the year. The mid-cap index is down 5.5%. The BSE small-cap index is down 9%. And no other major market has given negative returns since the start of the year. Cameron Brand, Director Research at EPFR Global, is now joining in. Cameron, just first fill us in with the kind of flows that we've seen or outflows from India vis-a-vis the rest.
Well, they've really flown somewhat under the radar because there were such enormous outflows from China-dedicated funds over the past week. The conventional wisdom is that China is trying to take some of the steam out of its market ahead of the Chinese New Year holiday. But those numbers have been so eye-catching that between that and sort of the European dynamic with Trump's pressure for concessions on Greenland has actually meant that I don't think a lot of attention has been paid to India over the past couple of weeks.
What's the number? You said we've seen massive outflows from China-dedicated ETFs in the last 1 week.
Yes, sort of over 40 billion last week alone. So that was a 1 week record and came after a period of increasing inflows as the Chinese equity market headed towards levels last seen in 2015, which was obviously a year when it suffered a rather destabilizing correction.
What were the other notable flows in the other emerging markets? Of course, insignificant when you compare it to this $40 billion of outflows from China ETFs. But just give us a sense of what's happening in terms of the flows in the other emerging markets and on India, if you have any numbers.
Yes, so India had an outflow of about 320 million, which is not terrible, but not particularly good either. And Korea was the big winner. Close to 2 billion flowed in last week. Korea offers a bit of a reform story, a bit of an artificial intelligence story, and it seems like Trump is going to pull back again on the latest tariff threat. So it has a fair amount of wind in its sails at the moment.
Cameron, just in the flows that you track, are there any commodity-related flows that you track, especially gold, silver? Anything you can tell us?
Yes, so gold is dominating the commodity story. Both physical gold funds and funds that offer exposure one step removed through gold miners. The other story commodity story that's really playing out at the moment in flows is that Latin American funds are doing really well, and a lot of it is tied to the fact that Peru, Mexico, and Chile are all in the top 10 in terms of copper production. And these data centers that are sort of a hot story, hot investment theme, certainly here in the US, by some estimates, they're going to need 400,000 tons of copper over the next 5 years. So we have gold, which is something of a fear play, and a lot of interest in Latin America's copper production, which is something of an AI play.
Hi, Cameron. Good to see you, Ben. What about silver? That's the one that's actually outperformed even gold, a precious as well as an industrial metal.
Yes.
What are the flows out there? Because, overnight when you have a metal moving 10% both directions, you're wondering what's going on there. So tell us your reading.
Right. So my reading is that investors seem less convinced about silver than I think perhaps they should be. As you say, it has a range of stories, and there's also a fairly significant production deficit relative to demand. So I think, the sort of core reason for the price going higher is certainly sound. But there's something about silver, certainly here in the US, that seems to attract speculative interest, including the sort of all-out retail investors. So I think people are a little nervous about it. We've seen very choppy flows into dedicated silver funds, lights out one week and then they pull back pretty sharply the next.
Okay, Cameron, we'll leave the conversation here for now. Thank you very much for joining in and just painting the near-term picture in terms of what's happening with respect to flows in equities and commodities. Time for a short break, but we've got lots of stock-specific action to track today, and we'll get to it in just a bit in our special Top 10 segment. We're looking at Axis Bank, Ultratech Cement, JSW Steel, BPCL, Godrej Consumer, Urban Company, MCX. All these are likely to open up in the green on the back of positive news flow earnings. Innocent Bank, JSW Energy are the stocks that could open in the red, while it's a mixed view coming through on Kotak Mahindra Bank. Welcome back. Lots of earnings reactions over the last 3 days to reckon with this Tuesday morning. Our research team is standing by with CNBC-TV18's list of top stocks for the day. But first up, there are 4 nifty earnings that we need to react with. I'm counting JSW Steel also because it came just in the dying moments on Friday. But let's start with the big banking numbers. Gaurav is now joining in first with Axis Bank and then tell us about Kotak too.
Well, yes, if you look at Axis Bank, actually a very good set of numbers is what we call, and specifically because of the core numbers that were actually, those numbers were actually better than the street's expectation. So net interest income that increased almost by 5%. The same performance, if you look at PPOP, that grew by 3%, and it was carried to PAT as well, where we saw 3% growth on a year-on-year basis. Now, if you look at PAT and the 3% growth, the number may look a bit small, but it is actually higher than the street's expectation. Now, what remained a key positive is that if you look at provisions, they came down. As a result, if you look at calculated credit cost, that declined almost from 1.3% to 0.8% just on a sequential basis. Other than that, slippages, which were actually elevated for Axis Bank, they also remained sequentially stable on a quarter-on-quarter basis. Other than that, net interest margins, they declined by 9 basis points, but it was in line with the street's expectation. And lastly, the commentary from management, that also remained positive. They said that they are actually aiming to grow 300 basis points faster than the industry, which has been their statement. But if you look at the growth numbers in this quarter, at least, we have seen them delivering 14% growth in loan book, which gives some confidence on the management. On the back of all these numbers, now brokerages, Citi has upgraded the stock to buy with a target price of 1436, and the reason being that they say that core earnings, they surpassed the expectations. And if you look at Nomura, they also have an argument saying that the valuations are still at an attractive level and lower than Kotak Mahindra Bank, and that is the reason why the bullishness in the brokerages also remained for Axis Bank, and as a result, we are going with green on Axis Bank today.
All right, thanks a lot for that, Gaurav. Well, I'm focusing on Ultratech Cement, and those numbers look good. Top line beat, which further percolated down to the EBITDA beat. Margins were better, and the profitability as well looked better than what we were working with. A few factors that played out. One is the EBITDA per ton. Well, it improved by close to around 100 rupees on a sequential basis, despite having pressure on realizations. Realizations were down by around 3% or thereabouts. On a year-on-year basis, the EBITDA per ton was up close to around 140 rupees. Now, that's heartening. So operating leverage played its part because the consolidated volumes were up by close to around 15%. Remember, the industry grew in high single digits, so the big daddy is outgrowing the industry by a mile. And also, they have that inorganic growth that's playing a role out here. So operating leverage did play out, and select cost, whether you look at the power and fuel cost or the other expenditure as well, that did dip, telling you their focus on efficiency as well as operating leverage did play out. The net debt number, well, that came down by close to 1,700 crores, so the street like that. And the con call takeaways, I think the street was just saying that they were very, very teasy. The all India growth, they are expecting that the demand will grow by around 9 to 10% in comparison to 6 to 7% that we see in the first 9 months. They're saying that the price increases have been to the tune of around 6 to around 8 rupees, which is good, and they're expecting pricing to remain strong. And finally, they said the EBITDA per ton will improve in the coming quarters. So put all this together, Ultratech Cement delivers good set of numbers, deleveraging seen, and commentary positive. Green on that one. But Gaurav, back to you. Kotak Mahindra Bank, how are the numbers?
Well, if you look at the numbers were actually in line with the street's expectation. In fact, profit was a bit lower than the street's expectation, and the reason being that there was 92 crores of impact because of the new labor code. So if you look at the numbers first, net interest income grew by 5%, PPOP grew by 8%. It was a bit lower than the street's expectation, and profit that grew by 7%. Again, because of that PPOP decline, it was actually 7%, which was lower than the street's expectation. Now, what remained key positive is that credit cost. Now, here also we saw the asset quality improving because credit cost declined almost by 16 basis points. Remember, the street is expecting around 7 to 8 basis point of decline. If you look at slippages, there also we saw 7 basis point of decline on a sequential basis. What actually was a bit negative is that the net interest margins, now they remained flat on a sequential basis. Street is expecting some uptick in net interest margins, but commentary, that was actually positive because management said that in Q4, we may see a marginal moderation in net interest margins because of the marginal improvement in net interest margins because of the CRR support. Lastly, there was another factor as well. Now, there are some rumors which suggest that Kotak Mahindra Bank is looking for an acquisition. On that, management said that any M&A should financially and strategically fit the company and be smooth to integrate. Now, what brokerages are reading through this is that first is Jefferies. Jefferies believe that the commentary on M&A that suggests that lower probability of the IDBI deal, which is speculated by the market. But on the other hand, Investec, while they gave the hold rating, what they're saying is that the Kotak Mahindra Bank is still trading at a higher valuation versus its ROE, which is at around 12%, which gives a limited upside for the bank. And that is the reason why I'm going with yellow for this bank today.
Okay, all right. Thanks a lot for that, Gaurav. Well, I'm looking at JSW Steel. The numbers, in fact, look pretty much in line. The EBITDA number at around 6,500 crores, margins in the vicinity of around 14%. But the PAT number looked much better. So you're wondering how the operating profit is in line when the PAT is much better, because there was a tax credit of around 950 crores that compares with the tax expenditure on a year-on-year basis. So that explains why the PAT number looked out of whack. Volumes, well, they were quite good. On a year-on-year basis, because of the capacities coming on stream, came at around 7.6 million tons. That compares with around 6.7 million tons. And the calculated consolidated EBITDA per ton on a year-on-year basis, well, it was more or less stable. On a sequential basis, it declined, but that was on expected lines. The company is going full throttle. They're going with a big expansion out here. CapEx was announced for a 5 million ton greenfield facility in Odisha. And the total expenditure they're saying is 31,600. That's not too bad for a greenfield capacity that's coming on stream at less than $700, so which is actually quite encouraging. Net debt number holds steady at around 80,000 crores odd. Brokerages, well, they're split down the middle. Jefferies, they reiterate their buy rating. They have a target price of around 1,400. They are saying that the EBITDA will improve to around 8,700 from around the 6,500 in the past quarter. However, Nuvama as well as Equirus, they're cautious on the stock because of valuations. They're saying valuations leave little headroom on the upside. We're going with green on this particular name. Gaurav's back with us. Gaurav, IndusInd Bank, how are the numbers?
Well, IndusInd Bank, if you look at the numbers on the top line, it looks like a beat, but there was a one-off. So net interest income declined by 12%, but there was a one-off of around 211 crores in the top line. And that is the reason, if we exclude that net interest income will be in line with the street's expectation. PPOP, that declined almost by 37%, while profitability declined by 90%. Now, these numbers may look very large, but this was because of the base effect. And if you look at the profit, bank actually reported profits of 128 crores versus the losses that they had reported worth 430 crores in the last quarter itself. What was positive is that net interest margins, they increased almost by 3 basis points. If we exclude that one-off, the increase in net interest margins is 3 basis points. It is actually a bit positive. And credit costs also improved almost by 60 basis points on a sequential basis. Other than that, slippages, they also remained stable, while management also said that the slippages were range-bound across the segments, except for micro loans and some bit of vehicle finance to some extent. Other than that, the commentary on the MFI also remained positive. They said that the MFI growth will kick in from fourth quarter of FY26, and the growth will be overall in line with the industry by the end of fourth quarter of FY27. But there is another overhang which can actually act as a negative catalyst for the stock today, which is the capital raise. Now, there were rumors that IndusInd Bank may be looking for capital raise, but now management has cleared the air. What they're saying is that they do not anticipate any capital raise in the foreseeable future. Other than that, from the brokerages also, the verdict was not that strong. IIFL, while maintaining sell rating, they said that the valuation is not cheap even at this level because the ROAs are still a bit weak. And at the same time, Bernstein, they also said that the visibility for strong growth is still missing from the results. And that is the reason why I'm going with red with this stock today.
Thank you very much for that. Sonal joins in now with BPCL. Sonal.
Good morning, Reema. Well, it was a good set, a top-down beat when it comes to BPCL. Our revenue is at 1.2 lakh crore rupees, EBITDA at 11,676 crore rupees, which was higher than the poll of 10,645, margins at 9.8%, and the profits were around 800 crores higher than what the poll was suggesting. It was a refining-led beat where the reported GRMs came in at $13.3 per barrel, which was a growth of 23% sequentially, 137% on a YY basis. Marketing volumes also increased both on a YY and on a sequential basis, and strong refinery throughput growth as well. So that is something which is positive this time around. Jefferies says that valuation for BPCL is the cheapest in the peers, and earnings outlook is now healthy with crude market oversupplied in calendar year 2026. However, the company has announced new massive capex, which they'll be executing by 2030. That is something which could stretch their return on capital employed. They have a target price of 470 rupees a share, and after weak earnings from HPCL, especially on the refining front, this has come in as a positive surprise.
Okay, all right. Thanks a lot for that, Sonal. Going across to Mangalam. Mangalam, tell us about Godrej Consumer Products.
Godrej Consumer is a good set as expected. You know, the company had given us a cheat sheet already, and on that as well, the EBITDA is actually a beat versus street's expectations. The net profit impacted by an exceptional loss, but if you adjust for that, it's largely in line out there as well. Revenue at 4,100 crore. The street was expecting a number of 4,110 crores as well. The EBITDA, 880 crore versus expectations of 850 crores where the beat is. And that's flown down to the bottom line as well. Rather, the margins as well, 21.5% versus expectations of 20%. And the bottom line, 500 crore on the net profit as against expectations of 600 crores. And that's because of an exceptional loss of 91 crore, of which the most part was on account of the new labor code. Domestic underlying volume growth, 9%, among the highest that we've seen in the industry so far, so that's a positive. Even the home care and personal care business in India did well. The company has said that they've gained market share in personal wash, and fabric care continues to do well for them as well. This is a category that they recently entered and have been making big waves out there. And Indonesia, that was a bit of a problem, but the company said that they are seeing signs of stability out there, with operating conditions expected to improve as early as the start of next financial year as well. So all these factors going with green on Godrej Consumer.
Thank you. Vivek, it's over to you for JSW Energy.
Well, that's right. So JSW Energy, remember, the company has had a lot of inorganic growth that's come about. On the back of that, you did see significant growth as far as the top line was concerned. So revenues higher by 67.5%, EBITDA jumping on the back of increased contribution from KSK Mahanadi as well as the O2 power platform. So EBITDA jumping up over 2 times. Margins are too quite healthy at 49.8%, but on the back of the fact that there has been significant leverage that's been undertaken for this M&A, there was a significant spike as far as interest costs were concerned. On the back of that, when you're taking away the tax write back that the company received, it's actually a net loss that JSW Energy has seen in this particular call. So also remember, this particular quarter, it's a seasonally weak quarter, especially for renewable energy companies. FY26 has been a muted year as far as power demand is concerned. So JSW, that has merchant capacity, has actually seen a certain amount of weakness, both in demand as well as prices falling as far as the day-ahead market is concerned. What is the good part? Generation up by 65%. Good EBITDA contribution from both Mahanadi as well as the O2 portfolio. On the other hand, higher funding costs is something that is going to ail the balance sheet going forward, and lofty valuations despite the underperformance that the stock has seen going into Q3 results.
Got it. All right. Thanks a lot for that, Vivek. Going back to Mangalam, Urban Company, how are the numbers?
Well, Urban Company, the revenue growth has been very good. Even the operational performance ex InstaHelp has been very good. The bottom line and the reported operating numbers have been impacted by the increased investments in InstaHelp, and that's something that the management had told us already. So the revenue growth of 33% at around 382 crores is a positive. The company said ex InstaHelp, the EBITDA is actually a 44 crore mark, with 4.2% margin of their net transactional value. So that's a positive as well. Indian business, 25% revenue growth, 50% EBITDA growth. That's a positive, along with Native, which has actually seen a doubling of revenue, along with a massive reduction in the losses of their operating performance as well. So all these factors point towards green. The one thing we'll have to look at is InstaHelp. Now, in the third quarter, which is basically the third quarter of their operations at InstaHelp, the revenues at around 7 crores, while the investments that they've made is around 61 crores as well. The company said that their loss in InstaHelp will continue to reduce quarter over quarter from here on, and they have a target of 1,000 crore EBITDA by FY31. So all these factors, I'm going with green largely because the other internals of the company are stacking well, even as growth for InstaHelp is on track.
Got it. Okay, Mangalam, thanks for that. Hop across to Ria. Ria, how are MCX numbers?
Well, MCX has reported quite a good set of numbers in this quarter, beating estimates across the board for quarter 3. The growth this time around has been driven largely by the rally that we've seen in gold and silver. The average daily turnover as well for the company in the F&O segment has been up roughly 82% sequentially. They've also launched new products, Gold Mini, Gold 10 Futures, as well as MCX Bulldex, which have aided growth for the company this time around. Looking at the revenue as well, that has improved by roughly 78% sequentially. The EBITDA and net profit each have gone up by 103% on a sequential basis as well. And even the margins have seen a huge bump up this time around, coming in at 74.4% versus 65.1% that we saw in quarter 2 of FY26. So overall, good set of numbers, and the stock is expected to open in the green today on the back of this.
Thank you very much for that. Let's do a quick recap then of the stocks. Stocks with positive news flow are Axis Bank, Ultratech Cement, JSW Steel, BPCL, Godrej Consumer, Urban Company, MCX. Stocks with negative news flow are, as you can see on your screen, IndusInd Bank, JSW Energy, Kotak Mahindra Bank could see a neutralish reaction. But lots of big earnings coming out today. You've got Asian Paints, CG Power, Vodafone Idea, Marico and Tata Consumer. But lots happening in the world of commodities. Big bazooka moves seen in gold, silver, natural gas. Manisha is here to give us a complete roundup. Manisha.
Thank you so much for that. Absolutely. When you look at the silver prices, from $100 to $110 an ounce came in a day, and we have seen an all-time high of $117 an ounce as well in the international markets yesterday. Well, it's a 6% of gain that you're looking at in the Asian markets as well right now. It has to do with a lot of safe haven buying, a very heavy debt that the Western world seems to be carrying on, and of course, more tariffs, geopolitical tensions, All of that has been very, very supportive for silver, which is now trading above $110 an ounce. Gold as well has seen $5,100 an ounce of all-time high. We are looking at a lot of money flowing into this one. So whether it is via physical, ETF, and even gold funds, almost every aspect seems to be doing quite well here. You spoke about natural gas prices. Well, yes, we've seen nearly 10% of gains in last two trading sessions when it comes to this one as well. Markets do believe that with the kind of winter that we have seen in the Western world, strong demand because of that and declining inventories are quite favorable for that commodity as well.
Thank you very much for that, Manisha. We'll keep coming back to you for more action. For now, it's a break. On the other side, the management of Gokuldas Exports will join in to discuss the potential tailwinds from the India-EU trade deal. Stay with us.
Okay, well, welcome back. There's, 25 minutes to go for the pre-open session. We'll focus our attention back to the EU-India FTA. And this is an exclusive to CNBC-TV18. EU Trade Commissioner telling CNBC-TV18 that both India and the European Commission are looking forward to signing the deal. This is today. Of course, I mean, there are legalistic issues which will be ironed out and operationalization by early 2027. Listen in.
Was very much encouraged by the ambition of Minister Goyal, who would like to ratify this agreement as soon as possible. And we will do our utmost to match this ambition, because, of course, being a little bit legalistic here, what will proceed once we get to the agreement. You have to do the legal scrubbing. In our case, we have to do the translation in 24 official languages and then, of course, proceed with all the procedures. But I think there is a huge interest on both sides once we agree to really offer the positive outcome of this agreement to our economic operators and wider public as soon as possible. So I hope that by the next year that we can actually benefit from this agreement.
So by 2027.
Yes.
Let's welcome in Gokuldas Exports now joining in. And we have Siva Ramakrishnan Ganpati, Vice Chairman and Managing Director of the company, now joining in. Siva, good morning. Great to have you with us here. Thanks very much for joining us. And I jokingly refer to Gokuldas stock as the India-US trade deal indicator. But only in jest, Siva, I hope you understand. We've got the India-EU FTA now, which is, of course, going to be at least the closure of negotiations. That's going to be signed today, operationalization early next year. Give us a sense of the impact this will have. What are India's exports, apparel exports to the EU? What is the share of EU apparel exports that Gokuldas has at this point in time? And what will this mean?
So, in the, at the onset, I think the EU FTA signing is a good step, a very positive step for Indian apparel industry, and for that matter, many more industries out of India. Our exports to US is about 5.3 billion, about 30+%, and EU is also at similar levels. These are two major markets for the globe and for India as well. And that market, when it goes duty-free, when it gives duty-free access to us, it represents a significant opportunity, particularly because EU today gets, Bangladesh, Pakistan, Sri Lanka, even Vietnam gets duty-free access to Europe. And when we often compete with these countries, and today we will, once the deal gets into effect, we will have a level playing field with them.
So 30% of your exports, 30% of your...
Historically,
Sorry, we lost you there. Siva, go on.
Was tilted against about India's, between 25 and 30% is to Europe. But Gokaldas's exports to Europe is of the order of 16, 17% and growing. So we were historically US heavy. We had 70% to the US. And now our European exports are growing very, very fast, consequent to the trade tariff that we have with US. And, in a matter of a year, we perhaps will touch close to 19-20% of exports to Europe as a percentage of our revenue. So we are increasing our European share. And this particular FTA will further give a fillip to it.
Yeah, okay. So just to clarify, your exports currently to EU, Gokul exports is 16 to 17%. You are growing that export to the EU very fast. It should hit 19%, 20%. Fairly soon. That's the...
Within a year. Yeah, within a year. Yeah.
Within a year. Okay.
That's right.
Okay. And this operationalization is only early to 2027, right? So that's the other thing, which is...
That is correct. That's correct. It will take time. Yes, it needs ratification from multiple countries in Europe. So all these processes take time. If you recall, the UK FTA was signed somewhere in August, and it is yet to take effect. So we will have to wait for that to happen.
Okay. Now, just one more thing, Siva. On Friday, there was a lot of, and the stock fell sharply, Gokuldas and other textile companies as well. This GSP benefits news that it has been now taken away. And so that provided a 20% discount to India. Whoever had the GSP benefits, and that was taken away. Is that correct, or we did not have the benefits and we don't have the benefits now? So there is incrementally no change. What's the understanding?
I think my understanding is that the EU tariff was 12%, and there was a 20% GSP benefit which got taken away. And again, honestly, that is not really a deal breaker. The business to Europe is not going to be changed, at least from our standpoint, because of that. The real deal here is the FTA coming in, which will make a significant a positive impact to the trade between India and Europe. That 20% is 2.4%. It really doesn't, it's on the fringes. It really wouldn't make a difference.
No, till 31st of December 2025, did you have that benefit? And now you don't? Or you did not have that benefit for some time before that? That is the understanding we got from Delhi, that this was anyway slowly getting taken away. So it was not there. So I'm just trying to understand from 31st of December, is there a change, that has happened?
To the best of my knowledge, I've been also traveling, so I've not really been on top of that particular, changes on the fringe.
Okay.
But I believe that there is a minor change, but then it needs to be ratified. It needs to be verified.
Okay.
So this will put you on a level playing field with countries like Bangladesh and Pakistan now. Once the deal comes through, calendar year 2027 and onwards, will you look to lower your pricing by the duty savings and grab market share, or keep the pricing as is and pocket it in the form of EBITDA margins?
So at the moment, we sell on an FOB basis.
Okay.
So the duty is paid by our customers. So if once the FTA comes in, it improves our competitive advantage. Obviously, the duty saving is an opportunity for us to nudge our prices up and try to share it with our customers. So at the moment, if the prices were the same, the benefit goes to the customer. Usually what happens is since we, there is a 12% advantage on the table, there will be some amount of benefit that we suppliers could also get out of that. Okay. So it can help us improve prices rather than, reduce it.
Got that. And what will that mean to your overall margins then, since you will be looking to increase prices, part of which will flow through into your P&L as well? What is the overall view on margins going forward for this year, next year, and even on CapEx? Now that you've got another market which is going to be increasingly more competitive for you, would you look to increase your CapEx?
So our margins, obviously, there will be a positive benefit to the extent of European business. As I said, our European business is only in the teens as a percentage of our total revenue, which I'm hoping will go up. As far as CapExes are concerned, we will be cautious since we are US-centric. and the US tariff is yet to play out. We will go slow with our capex, capex in the year ahead. We believe that the EU FTA will take time, so it's going to come sometime in 2027. So well in time, once the deal is signed and we see some visibility onto the trade deal fructifying, we will start pushing capex from our side. We have enough capacities at the moment. All our capacities are running full. We will try to build incremental capacities as we get closer and closer to the deal date.
Okay, all right. So very quickly, before we let you go, what about the US market? What are the last interactions you've had with the customers out there? What are the indications that you're getting from them? Because clearly, with the current tariffs, very difficult to do business with the United States customers. But what is the recent feedback? If you could tell us the situation on ground.
So obviously the high tariff is a cause of concern. India is facing the brunt of it because other countries are at more or less 20%, while India is at 50%. We have been fortunate to have a fairly strong order book despite being US-centric. Our order book for all the way to Q1 is pretty full, and all our capacities are full. We are also looking at booking our Q2, with the current set of customers that we have, and that's also going in the right direction. So we're not seeing a headwind from that perspective. However, we are seeing a margin headwind. Because of tariff, we are giving, sharing the burden of the tariff with our customers, which is impacting our margin. So our EBITDA margin has come down, particularly because we're sharing our margins with our customer, the tariff burden with our customers. And I think that will remain for a while till the US tariff is restored. We are trying our best internally to nudge our margins up by, better cost management, etc. That's part one. And part two, by moving a lot of business to Africa, where we have factories. We're seeing a strong tailwind growth there. And that's because their duties are very different from Africa to US. And there we are seeing some substantial growth in business going forward.
Okay, so you're saying in terms of order book, US-specific client order book, Q1 that is January to March, that is full.
Q1 of financial year.
Oh, so, I'm sorry. Q1 of, that is April to June.
Financial year. So, is also full for us.
Okay.
And we're working on Q2, which is also going in a good direction.
This is US kind of ordering.
Yes.
I mean, okay.
Yes, absolutely.
Okay. But margins are margins. Could you give us a sense where are US margins, Siva? I mean, what's generally broadly?
Well,
US
margins
company-wide, but yeah.
US margins are in low single digits. So, unfortunately, and company-wide margins will be in single digits, plus on the higher single digits. Yeah.
Okay. Got that. Siva, we'll leave it there. Thank you very much. We hope things get better. I mean, with the EU thing, I think things are moving in the right direction, and maybe with US as well. Sooner rather than later, we see some reprieve. Thank you for joining us with that clarity. Okay, I mean, sharp fall there on your screen. So important to get that clarification, and I think very, very closely watched name in that sense. We take a break. We're back. Dharmesh Kant of Chola Securities with us on the other side.
Welcome back. Well, we're joined by Dharmesh Kant, Head of Research at Chola Securities on the show. Hi, Dharmesh. Hope you had a good, long weekend. Well, quite a few numbers came out, so I'm sure you would be analyzing quite a few of them. Let me ask you about UltraTech Cement. You have your ear to the ground with regard to some of the cement prices, and you've been sounding us that off as well. UltraTech Cement's numbers were good, but the commentary is full on. They are very, very optimistic about the future. What is your take on UltraTech Cement? And from the cement basket, what do you like?
Yeah, good morning, Nigel. Thanks for having me for the show. Yeah, the numbers were pretty much in line, and they have seen a significant uptick in the EBITDA per ton for UltraTech Cement. And I think the volume growth is likely to stay, though even on a normalized basis, the volume growth was there. And what we are sensing out across pan India is that the volume growth of around near high single digit to early low tens will be there in Q4 as well, with slight, price uptake of say 2 to 3% on the blended basis. So that is what the sense is coming. Ultratech is the India's largest cement player, and they have been servicing the dealers very well. So the ability to get the sales through on a more effective basis is what is being said. Valuations do sound a bit expensive. Management has been gung-ho quite for some time, and 1.5 to 2 years they have been sounding pretty bullish on the entire cement space. And they have also said that South can be the new North. So we have to see that. But India Cements also have been coming up quite nicely after it has been taken over by Ultratech Cement. So our sense is price-wise, we may not get that much gain for say next 2 or 3 months. But if your investors stay invested, the entire year looks pretty good for all the cement companies. Ultratech remains the topic out there. So 15-20% upside from here on, if your investor was 3 to 6 months, looks likely on the cards.
Got that. Dharmesh, good morning. Good to have you with us here. We just spoke with one textile exporter, Gokul Das. Prices down to 550 and others in that space. This trade-related hit that many companies across sectors have seen, you think that some of that starts to abate a little bit? The pressure starts to abate? It's not the US now, it's EU. But any thoughts at all? Anything where there is outsized opportunity?
Yeah, good morning, Prashant. I think the last word which you said, outsized opportunity, looks unlikely in the near term because US deal is still lingering on. It's not happening. We had just heard that there will be a margin compression. The tailwind is coming from the currency depreciation, it will mitigate some part of the margin compression. EU trade deal, even if it happens, it's likely to be beneficial from next year, on the calendar year, January 27 onwards. So I think it's more of, having positive sound bites across the sector. But the reality and the fact remains that margins will continue to see sharp pressure. And other countries, though Indian companies are trying to have their, units set up in other countries, but they are also, fighting back well, and they are gaining business traction as compared to India. That is what we have, our checks suggest. So my own sense is trading also may be there. But from long-term perspective, this sector will be there for some betting in a medium to, say, 9 months kind of a time frame.
Yeah. Dharmesh, Rima is going to highlight some auto companies, etc. Right? We'll know the details later, but tariffs on EU cars, European car imports into India, they perhaps go lower as part of this trade agreement. Above a certain, I think it's 15,000. The reports that 15,000 euros is the threshold. Cars above that particular threshold, tariffs are going to be cut meaningfully. Maybe means more competition for Indian companies. Any thoughts here, especially for the likes of Mahindra, etc. Dharmesh?
Yeah, definitely. We have to see whether this is on EV vehicles or ICE vehicles, so that all details are awaited. But in case if it is 15,000 euro plus kind of, then definitely there will be a competition for all, 20 lakh plus car manufacturers in India. Mahindra will definitely be in for a tough competition. At the same time, even Maruti, which is trying to fall into the premium segment, will have serious competition along with Hyundai. So with the kind of price run-up which we have seen in all these companies, I think it's time to stay light. You can book your trading profits out there. But upward price traction and the 2 to 3 years kind of a perspective investment is definitely challenged if this comes through. But let's wait and see the fine print, and then only I think our detailed conversation can take place on this.
Okay, let's focus on the other name then from the Ferris pack, JSW Steel. Numbers pretty much in line, but the coming quarter will be far better. Last quarter, pricing was under pressure. In fact, it was at multi-month lows, the prices. Now that safeguard duty has come, and the prices have moved up by around 3,500 rupees in January itself, most of which will flow to the EBITDA number. What is your view on JSW Steel? The stock is not cheap valuation-wise, at around 8 to 9 times EV upon EBITDA, but it's been executing very, very well.
Yeah, the execution has been there. At the same time, the market share traction has also been seen in JSW Steel. We have been recommending this company for last 3 to 4 months consistently. In the Ferris space, we have been liking JSW Steel among all others. I think operating efficiencies will also play in, and management has sounded very aggressive on the capacity expansion part as well. So keeping everything into perspective with safeguard duty on, you can, I mean, it's still time to be long on JSW Steel and infra plays on. Let's see how the budget pans out on the entire infra spending. If there is some positive trigger out there, then again, a good run up in JSW Steel is likely. So but these are the sectors, metals, banking, where we are fairly bullish on and keeping them for 6 to 9 months kind of a trading investment perspective.
Okay, all right, Dharmesh, we'll leave it there. Thank you very much for joining us. Appreciate your time here on CNBC, and we'll speak again. We take a quick commercial break here. There's the pre-open which comes up. We have Digant Haria of Green Edge Wealth to discuss the banking results which came over the weekend. We'll also connect with our technical experts, Sudarshan Sukhani and Mitesh Thakkar, for some trading ideas. Stay tuned, coming up.
Welcome back. 16 minutes to go for markets to open. Last week was a tough week for our markets. The question is whether we will defend that 24,900 mark that we hit, the recent low on the market. It's also the Nifty monthly expiry, a lot of earnings reaction. But this morning, there is a gap up opening for the GIFT Nifty, perhaps on the back of optimism surrounding the India-EU trade deal. So that's Sukhani and Mitesh Thakkar now join in to help us with the trade setup. Gentlemen, good morning. Thank you very much for joining in. Mitesh, let me start with you. If there is a gap up opening, would you play it? What are the key markers for the day and for the week?
So I think, a couple of observations on the Nifty. One, starting from May of 25, we got a low of around 24,000, and then we got multiple lows in the month of August, September, and October. If you join that entire, all the lows, the resulting trend line is placed around 25,000, 24,950. So one, we are at a support area. The weekly charts are looking very negative to me. So in this case, when you're at a support area, when the medium-term outlook is not very positive, one, a good strategy is to possibly take profits on the short positions if you've been carrying, you've had some index put spread. So if other people also have some kind of short positions, this is a good time to book them. Wait for a close below 24,950, 25,000 zone, and then, get into fresh shorts. Given the fact that we are looking at a bounce back today, I think I would, pencil in levels of 25,400. I think that's the first target of the bounce back. Only if we capture that, I think, then we'll gain more strength. And getting into budget, this will be a volatile and news-heavy market. But overall, 25,400 on the upside is the reversal point. Till then, take off your short positions. You can get into some longs for a few days kind of a perspective, which is 3 to 4 days.
Got that. Sudarshan, hi, good morning. How would you approach a gap up opening? Would you play it? Because it's been such a one-sided fall for the markets. At some point of time, we will see that short covering. Today, you're getting that impetus in the form of the India-EU trade deal. How would you approach it, and what are your observations?
Yeah, good morning. See, the longer trend is currently down. I think we all understand the 200-day moving average has been breached on the downside. All kind of technical indicators suggest that the downtrend is not only visible, it's also stable. So as far as the trend is concerned, we are not looking at any optimism. But as Mitesh pointed out, and on Friday itself, even before the EU deal, could really come into play and picture, the markets are going into a choppy direction rather than down. So Friday's big move on the downside was also considered, I would consider that to be some kind of a support which did not breach 24,900. Today, the gap up suggests a buying opportunity. Keep a tight stop at 25,000 and then let it go. At some point, it will stop. So be nimble and take profits wherever you want.
Do you have a resistance level in mind for on the way up? And what about stock, Sudarshan?
See, the resistance level is roughly the 25,300, 25,350 zone. Is almost what Mitesh has also discussed. The stocks are primarily on the long side. Dr. Reddy's is a buy with a stop under 1215. Shriram Finance, I also own some shares in it, is a buy with a stop under 985. Ashok Leyland is a buy with a stop under 190. My only intraday short is MCX, which is an intraday short with a stop above 2340. Otherwise, I am looking to buy thanks to that gap up and the better environment.
Mitesh, your stock calls?
So I have a mix of buy and sell more towards the buy side, given that in the short term, I also expect a bounce back. So HUL is a buy with a stop at 2389 for targets of 2450. A buy on OFSS, Oracle Finance, with a stop below 7900. Look for targets of around 8100 here. Also buy on Bandhan Bank. Keep a stop below 146. Look for a first target of 155 to about 156. And one sell call, that's IRADA, IRADA. Around 129, sell with the stop at 132.5 for a target of 122.
Thank you, gentlemen, for joining in. We'll come back to you for the 9-10 calls. But the consensus view from both Sudarshan and Mitesh appear to be cover your shots, play the gap up opening on the way up, ride it till 25,300, 25,400. But the longer term, the medium term, trend still remains fairly downbeat and bearish. But a whole host of banking numbers were out over the weekend. Axis Bank, Kotak Mahindra Bank in particular. Digant Haria, founder of Green Edge Wealth Services, now joins in. Digant, first give us your read on Kotak and Axis. How did it fare? What were the key trends and observations you had?
Yeah, hi, morning, Rima. Good to be here. See, I think large banks, all of them have one simple underlying current that, they're struggling in that 11-12% kind of growth, or maybe even lesser, like Kotak had a 9% kind of a growth. And that is mainly because, the PSU banks are doing too well and, they are taking some market share. So I think both the results were okay, just in line with what was expected. I think growth and margins will, have, been slightly disappointing for, all the large banks, right from HDFC to Kotak. And I think this is a trend, Rima, which will continue for the rest of the year as well, because the PSU banks are very healthy and they're competing left, right, and center in the market. So I expect that, these banks will underperform the PSU banking pack. But yeah, nonetheless, if somebody is happy with 10-15% kind of compounding, I think these stocks definitely fit that bill.
Which was the PSU bank standout performer this time, since your preference clearly lies with PSU banks rather than these large private sector financials?
I think a lot of results are yet to come, but I think Indian Bank, really stands out. Even the smaller ones like Bank of Maharashtra, Bank of India, a lot of them stand out. The big boys are yet to declare their results. But I think, that is where some action will be. And even regional banks, are reporting good set of numbers, be it Federal or, we had DCB also, which came over the weekend. And IndusInd is a mid-sized bank, which also came over the weekend. I think that stock is bottoming out. Their microfinance performance has started improving in line with other microfinance companies. So I think IndusInd Bank, amongst the large private banks, could be something which has bottomed out and, it could positively surprise over the next 12 months.
Okay, all right. Sounding optimistic, Digant, on IndusInd Bank. Good to see you in Digant. Nice and colorful. What about SBI? That's clearly been the leader of the pack, right? More than 1,000 rupees stock, and suddenly it got its act together, went through a long phase of consolidation. What's your view?
Yeah, see, again, I think SBI has outperformed the banking index, the markets, and its peers in terms of stock price performance. This outperformance is justified, but I don't think we should expect further outperformance from here, Nigel, because if you look at the banking sector growth, that is around 11%. SBI will probably end up growing around 12%. So unless the country's growth goes up significantly, I don't think SBI can outperform from here. It will be a market performer again, something like 12-13% compounding. But yes, very strong undercurrents in all the PSU banks. So yeah, that's the spot to be in.
Okay, all right. What about the NBFC space, Digant? You were on the money on a couple of names I recall in the past, Northern Arc and the likes. Currently, how do you like that? I think one of the earnings reactions of this quarter have been from Credit Access Grameen. The stock popped up 10% on a day that the markets were brittle. What stands out from there? What is your big pick?
Yeah, so Nigel, two really strong trends coming out of the NBFC pack. One is that, see, microfinance, the worst is really over. You can see it in results of, say, an Ujjivan Small Finance Bank, Credit Access, and even IndusInd, which reported numbers. The slippages have started coming down quarter on quarter. So microfinance, we can clearly say that the worst is behind. Improvements have started, and every subsequent quarter for the next 5 quarters will be improving quarters in terms of numbers. So microfinance is a clear turnaround. The turnaround has happened. Second, Nigel, is this gold and silver. Gold is shining, and we say that India has 35,000 tons of gold. But that 35,000 tons of gold, 75% of that lies in just the 3 states of South India. And there are these lot of gold loan players, especially these regional banks like Tamil Nadu Mercantile Bank, South Indian Bank, Catholic Syrian Bank. All these banks are really upping their game in gold. NBFCs have, usually been very good at gold loans, be it Muthoot Finance, Fedfina, and the likes. But even the regional banks are upping their play on gold. So somebody who has missed buying gold and silver, the physical metal, I think this is a good proxy which can do well for the next 12 months.
IIFL Finance, the management clarified that it's fairly procedural, the special audit that's been asked for by RBI, but the stock corrected very sharply. I think it was down 15% in a span of 2 days. What is your read of the developments at IIFL Finance?
Rima, the gold loan performance was stellar, really outstanding. Like, they really cracked the gold loan. They've captured the growth, very good growth coming out of them. But yeah, see, this is income tax audit. I believe what the management says that it is routine. See, in the last 18 months, they have gone through an RBI audit and an income tax audit. And then they have come out of it. So I think this should be routine. But again, as Rakesh ji used to say that shak ki dawa to sirf time, samay ke paas hai, which is like, you have to wait for some more time so that there are no adverse observations. But on the gold loan front, they're doing well. Their borrowing costs will eventually come down. They have a lot of levers. So this can also be kept in radar. But it's an issue which is beyond numbers. So we have to weigh our risk reward.
Okay, Digant, we'll leave it there. More questions. I mean, so much happening, right? And such a tough time, but interesting time all at once. Thanks very much for joining us with all that. Well, we'll take what we'll do is we'll focus on the auto space. And I was talking about this earlier. Will duties on imported, cars from Europe, I mean, will duties fall sharply, and what's the impact on competition, etc. is the point. So the EU Trade Commissioner spoke with CNBC-TV18 on this point. Just want to play that soundbite out, and then we'll get you some details.
If it comes to automotive industry, I fully understand that what was very important for Indian side was to make sure that your automotive segment will also grow in the future. And again, I think we are quite complementary. India is very strong in small and cheaper cars. European Union is strong in bigger machines. So we are looking at the way which would kind of help us to find the solutions, how we can also create new supply chains, how we can make a even better business case for European car makers, and at the same time to open also this new possibility for cooperation for Indian car makers. I mean, in such a big deals like this, you need to look for common approach, mutual understanding, and a best outcome for both. And I believe that we are heading in the direction.
Okay, let's just quickly talk about the impact on the automakers. So what we understand in terms of the deal contours is that as a part of the India-EU FTA, according to reports, the Indian government plans to cut the import tariffs on ICE, internal combustion engines, of cars with a value of more than 15,000 euro. Currently, the tariff on this is 60 to 110%. That will come down to 40% immediately. And then there is a glide path to further bring it down to 10%. And this will be applicable initially for a volume of 200,000 cars per year. Now, the impact on Indian companies. Now, the ex-showroom price for a European car, which is priced at 15,000 euros, turns out to be 23.2 lakh. This is according to Goldman Sachs, when you add all the customs duty, etc. So 23.2 lakh. Approximately 2,70,000 cars were sold in this bracket of above 23.2 lakh in the first 9 months of FY26, and that is 8.2% of the domestic volumes. So European brands like Skoda, Volkswagen, Renault, Mercedes-Benz, BMW, Audi all stand to gain. Collectively, these European brands collectively have about 3.7% of the Indian market. So who will be impacted here in India? Brands with high volume presence in the premium market, where the price of the vehicle is in excess of 23 lakh. So according to the analysis, the most impacted could be Hyundai. According to Goldman, as a percentage of the PAT, the impact could be 3.3% because of its strong presence in premium SUVs like Tuscan, Ioniq 5. Mahindra could also be impacted to the extent of about 2% because they have exposure to XUV 700, Scorpio, etc. If you add all the bells and whistles, the price is more than 23.2 lakh. For Tata Motors and for M&M, the impact is fairly minimal. So that is the initial analysis. Hyundai and M&M will be impacted, and EVs for now will be excluded for the first 5 years just to protect the domestic industry.
All right, Rima, thanks very much for that. I mean, the pre-open rates, slight sideways kind of movement, not very large at this point. Well, 9:10 call. Sudarshan is with us, and so is Mitesh. Sudarshan, what do you have?
I have Ashok Leyland as a buy with a stop under 190.
Okay, and Mitesh, what about you?
We'll go with the buy on OFSS for targets of 8,100.
Okay. All right. Thanks a lot for that, gentlemen. Well, let's focus on Ultratech Cement. First on the numbers, the EBITDA number was much better than what we were working with. There was a beat of more than 350 crores, and in margins, well, it came at around 18%. That compares with around 16.5% margin that we were working with. How was that possible? Well, the EBITDA per ton came at around 1,051 rupees per ton, which is an improvement of around 140 rupees year on year. And on a sequential basis, it was up by around 97 rupees. That's encouraging because, yes, they had solid volume growth. However, realizations were weak. And the consolidated sale volumes, well, that was up by close to 15%, which means that they outgrew the industry. Besides having the benefit of operating leverage, the cost declined as well. Notably, the power cost that was down by close to 15% on a per ton basis, and the other cost that was down by close to 7% on a per ton basis. Besides a good operational performance, the net debt number has come down by around 1,700 crores. And that's encouraging. Remember, now they've laid out their guidance. Currently, the domestic capacity is around 189 million tons. They're saying they'll end this year at around 198 to around 199 million tons. And the next 2 years, they'll definitely be at around 235 million tons. Earlier, they were guiding that somewhere in 2029, they'll be at around 235 million tons. That's the domestic capacity. So that's encouraging. The commentary was very, very bullish. They say the industry demand growth is expected around 9 to 10%, which compares to around 6.5%, around 7% that we've seen so far in the first 9 months. And the price hikes have come about 6 to around 8 rupees per bag. That's what the pricing is higher in comparison to the third quarter. Brokerages, they're bullish. Jefferies has a buy rating. Nuvama has upgraded the stock with a buy rating. They've upped the target price as well. CLSA says that the top conviction outperform call is what they have on the stock. And Nomura as well has a buy rating. So all the brokerages more or less bullish on Ultratech Cement. The big daddy has stood up, delivered on a good set of numbers. The stock more or less flattish. It's seen a bit of a run in the last few trading sessions.
Okay, well, we've got a couple of seconds to go for market opens, so let's just stick with prices and then we'll pick it up from there. So much stuff, right? And it's flattish, at least at the index level. There we go, 25,080, 58,470 on the Nifty and the Nifty Bank, respectively. So, I mean, slightly up on the Nifty and slightly lower on the Nifty Bank. You got sensex, which is up 0.12. Small cap index is up 0.5%. The mid cap index will come up as well with about a 0.4% kind of a gain at this point in time. 25,115 on the Nifty is where we are at. So it's a positive start. And now the Nifty Bank is also back in the green. Let's just look at the Nifty heat map in terms of where we are starting before we go any further. Kotak and some of the private banks, and we'll address some of these names in just a bit, are starting lower. So there you go. You've got Axis and Adani Enterprises and Adani Ports on one end. Remember, the Adani group all got sold into very heavily on Friday. So they're all starting and some rebounds there. And Kotak, Mahindra and Cipla are on the other end of the spectrum at this point in time. Rima.
Well, Axis Bank is your top gainer. Citi has upgraded the stock to a buy, raised the target price to 1436, while CLSA has an outperform call on Axis Bank with their target price standing at 1500. So that's on one end. On the other end of the spectrum is Kotak Mahindra Bank, where the numbers are fairly lackluster. Stock is down close to about 4.5%. The Labour Code impacting the bottom line. But even otherwise, the NIM expansion, which the street was hoping for, didn't come through. NIMs were flat on a sequential basis. Innocent Bank is the other bank reacting to the numbers, down 4.5%. Digant believes that perhaps the stock is close to bottoming out and could positively surprise. But Innocent Bank in early trade is under pressure. Adani Group stocks are racing away. Adani Enterprises, Adani Ports, both up close to about 2.5%. Nigel was saying Ultratech numbers look look stellar. Clearly, the leadership stock in the cement pack, stock gaining nearly 3%. Hindalco, JSW Steel, Coal India, so commodity plays very active. Hindustan Zinc should also come up for you on your screen after the kind of an up move that we had in silver prices. Hindustan Zinc too has opened up with a gain of 3%. So commodities on the front foot for private sector banks, Axis, Kotak Mahindra Bank on the other side of the spectrum. M&M is taking a big knock on fears that there will be increased competition from the European car makers following the India-EU trade deal. M&M opens with a downtick of 4.5% because many of their high-selling vehicles could get impacted and they've been contributing to this performance. M&M is under pressure. Eternal is weak, 5.5%. In fact, the entire auto complex is weak. Coming back to that, Tata Motors passenger vehicles, Maruti, where the impact is expected to be limited since predominantly they operate in lower-priced cars, but even Maruti Suzuki has a downtick of nearly 1%. The two heavyweights, HDFC Bank, Reliance Industries, have opened in the red. And Nigel, it's disappointing, right? There was a gap-up opening, which was expected, but now we opened in the green, but the Nifty has reversed, down 30 points, and now just about clinging on to that 25,000 mark in the red now for the key indices.
Well, Rima, there are plenty of actually disappointing earnings reactions as well. IFB Industries, that stock is down close to around 9.5%. Volume's not very, very large, but the street clearly didn't like those numbers out there. So that stock has seen some big selling, in today's trading session in the initial few minutes. Godrej Consumer, that stock, in fact, is down 6.5%. So big downtick is what we're seeing on Godrej Consumer as well. That one is selling off. One Source Specialty, the numbers were disappointing. That stock is down close to around 5.5%. SBFC Finance, Mr. Dhruv, I think, is moving on. He's going to be with the organization, but a bit of a rejig at the top. So that stock is well down close to around 5%. So all these stocks are seeing some profit taking. What's doing well? Go Fashion. They're going to be considering their numbers in the next couple of trading sessions. They'll also be considering a proposal for buyback of equity shares. So that's why Go Fashion is up close to around 10%. Big move is what we're seeing out there. DCP Bank, Digant just mentioned that those numbers look quite good and the street likes it. So that's outperforming today. DCP up close to around 5%. Silver is twinkling. So that's why you have Hindustan Zinc, the only play on silver. That's, up close to around 3%. And Vedanta owns Hindustan Zinc. So that's why that's participating as well. Bharat Coking Coal listed last week. Plenty of excitement out there. Valuations ran a little bit ahead of themselves. We had mentioned this, that, float is limited. The issue came at around 23 rupees. The initial tick that we saw was around 45 rupees. And now it's at around 35 rupees. All this in a matter of a week. So sharp downtick is what we're seeing on that counter as well. Net, the Nifty has come down from the top. Plenty of earnings reactions. A lot of them on the downside. Explains why the breadth of the market is negative.
The number one volume-led loser is Mahindra & Mahindra, which is down about 4.5% right now. Actually, across the NSE right now. So that's the top loser, as Rima just highlighted. That note from Goldman Sachs, they are putting the spotlight on Mahindra in terms of how lowering of duties in that particular segment, if it were to happen, will perhaps impact Mahindra. Out of the pack the most. They're estimating I think 3.5% impact, but we'll have to see how this one goes. Kotak Bank is the number 2 volume-led loser. IndusInd is the number 3. JSW Energy, Godrej, Nigel mentioned Godrej Properties. Actually, Godrej Consumer Products is down 3.5%. And Bharat Coking Coal, I think we highlighted. Lots of stuff. Novama is down about 5%. Stocks at about 12.30 or so. 12.60, beg your pardon, 12.70 now. So this is just about starting. Market breadth is 2.5:1. Wix is shooting up again. Wix is up. Let's just put up the India Wix. And the India Wix is up 11%. 11.5%. There you go. And I think that is clearly it's basically indicative of what's happening out there in the market, expecting high amount of volatility in the next couple of days. 75 points, which means already the Nifty, if you look at the Wix and the Nifty together, the Nifty is sold off almost about 150 odd points from the day's high. And this is just the first 5 minutes of trade. as we are looking at things right now. There you go. That's the complete reversal, complete collapse that we are seeing. 24,960. I would imagine, I mean, and this is just a sense, because Friday was so brutal and the market sold off in the way it did, at least till about 12 o'clock, till about 11:30, 12 o'clock, there would be a fair bit of forced selling by brokers, etc., margin-related issues, etc. Perhaps all that will culminate by and finish off by about 11:30. So maybe after that point, after about 11:30, 12, at least, I mean, that's what I would expect. Things get a little better. So we'll see if that is indeed the case. But for now, there is, of course, we've got a problem at hand. A 100-point cut is what you have. 24,950. Dheeraj Agarwal is with us, Managing Director, Ambit Investment Managers. Dheeraj, good morning. Good to have you with us here. Thanks for joining us. Let's just start with what no one is talking about yet, which is the budget, Dheeraj. I think because everyone is so busy with what's happening elsewhere, and of course, I mean, portfolios and markets going down, budget's not been on anyone's mind. What is your sense? I mean, I guess too late to ask you what the budget should do, because I mean, I think it's all been. I don't think it's all done, I guess, in that sense. But what do you think will happen? What are your, in that sense, expectations of what will be in the budget from a market standpoint, if any, Dheeraj?
So, interestingly, had you asked me this question even a while ago, what the budget should do, my answer would have been it's above my pay grade, because government will do what the government wants to do, and they've taken enough industry feedback. This budget, increasingly every single budget is reducing, the significance of the budget has been coming down in terms of its impact on the market. It's more of an accounting exercise, which is what it should be. Most of the significant changes now are outside the budget. So, for example, even this year we saw a significant GST cut happening in September. Typically, governments used to wait for budgets in the past to touch excise rates and income tax rates. Now, budget is actually more of an accounting exercise, a summation of revenue and expenditure, and see how the numbers tally. From that point of view, I expect the current budget to be a little bit of a non-event. With 8.5-9% nominal GDP growth, there is pressure on how much tax revenue growth government can budget for FY27. The government, I don't think, will allow fiscal deficit to go out of control, which means there are very limited expenditure levers this budget in the government's hand. Either it is RevX or CapEx. So I think it's going to be a balanced, non-event sort of a budget. And after one day of volatility on this Sunday, we'll go back to life as usual on Monday.
Dheeraj, the hope was that markets after last year's underperformance will slowly start climbing higher. And that hasn't transpired, at least to begin trade with. And one of the drivers was earnings recovery. But Q3 earnings so far, at least, appear to be fairly underwhelming, not very exciting, lackluster. I mean, how is it in the stocks that Ambit covers? How have the earnings season been versus your own estimates? Are there more EPS downgrades? Because up until now, we've seen so much valuation derating, but will the EPS downgrades also continue to take place?
Even last year, we saw EPS downgrades, right? If you remember, FY26 also, we started the year with 16-17% earnings growth, and we closed the year at 7%. FY27, again, the consensus earnings growth the market is estimating is about 17%. And so far, I've seen marginal downgrades come in. I haven't seen upgrades come in. So you're absolutely right in saying earnings so far has been underwhelming. There was a hope or an expectation that post GST cuts and very bold GST cuts in September, we should see a meaningful demand uptake and hence earnings coming through. Unfortunately, at this point of time, it looks like that the demand bump up was perhaps just 4 to 6 weeks, and it's already cooling off. So that's a sign of worry for sure. So I think you hit the nail on the head. We have to watch earnings more than anything else, because many parts of the world are seeing double-digit earnings growth, and if India doesn't, we may just continue to underperform.
All right, Dheeraj, good morning. Good to see you. But the last time actually we spoke, you were sounding a little bit cautious as well on the markets. Now the markets have corrected. Individual stocks have got smacked 10, 15, 20% as well. How are you feeling about the markets right now? Given the correction that we have seen, given the kind of sentiment that we're hearing, sentiment has got absolutely hammered. Do you think bulk of the bad news is gradually being digested and it's in the price? Or do you think we still have a long way to go and this is going to be a lot more painful before it gets better?
I don't know if it's got a long way to go in terms of absolute downsides, but I think this year continues to be a little bit of a struggle and painful. And so there are multiple forces at play. In absolute sense, you may be right that the valuations are no longer demanding and market should find a space. But at this point of time, India is suffering because of continuous FPI outflows. And FPI outflows are more relative than absolute. As per Bloomberg estimates, Korea is expected to grow earnings 40%, Japan 12%, US 13 or 14%. Even Europe is more than 10%. And I have a sneaky feeling that India will land at below 10% this year as well. So with continuous FPI outflows on one hand, continuous paper supply in terms of IPOs on the other, the amount of inflows domestic mutual funds are seeing is just not enough at this point of time to bring vibrancy back to the market. So I think this year will be a bit of a struggle year again. I don't know how deep the downside is, but it won't be an easy year to navigate.
You're saying FY27 EPS growth could be sub 10% versus expectations of 17%?
I think that's my personal view. I think it'll be sub 10 or around 10 or I'm not more than that. I see risks of EPS cuts. I see demand already faltering. I don't see any meaningful jobs growth happening anywhere. So, the one thing, the weak or tepid impact on demand from GST cuts tells me is we have reached a situation where just things becoming cheaper or interest rates coming down is not enough to revive consumption demand. We need jobs, we need income, and honestly, I don't see any strong signs of that at this point of time.
And maybe a little bit of deficit spending. It's above your pay grade there, as you said. But I think we need some...
That we'll have to ask the finance minister. It's way above my pay grade.
Most things are above our pay grades, Dheeraj. Greenland, EU, NATO, but the point is tariffs, right? But the point is we've got to deal with what's thrown at us. But, that question becomes important. And many have started to, once again, say why should that number be... Of course, not to go absolutely berserk. I don't think we will. It's been very, very disciplined on the fiscal side. But maybe, as you said, because just things becoming cheaper is not enough to revive demand. So maybe you need a little bit of pump priming as much as you can. But resources, of course, etc. We'll have to see if any of that happens. But you think possible?
No, I don't think so. See, when I sort of humorously or jokingly said it's above my pay grade. So, our job is to understand and read what the policymakers believe in and what they stand for, rather than continuously advise the policymakers to do what we want them to do. So when I said, advising the government on what should be in the budget is above my pay grade, my actual job at this point of time is to understand where this government stands. And I think the way this government behaved with a lot of discipline and restraint on spending, even during COVID, tells me that they will not bust the fiscal. Now, that's my reading. I may be wrong. It's a little bit of a crystal ball gazing here. But if they didn't bust the fiscal too much during COVID when the whole world was doing it, I don't think they will fall to temptation at this point. They might try and do resource mobilization from other sources like PSU privatization or sell-off or things like that and try and eke out some dollar here and there. But I don't think this government it's in the DNA of this government to bust the fiscal.
No, don't use the word bust, Dheeraj. No bust. Only maybe just increase spending, that's all I mean. But the point, Dheeraj, is that they've also changed track. Like, for example, 2 years back, the budget moved very clearly away from capex spending, right? This was the 2025 budget, right? So, they've also responded in that sense to what perhaps has been required. The other thing is, again, I'm just sticking with the budget on gold and silver. Actually, we've not even looked at the rupee. If you can just quickly pull up the dollar rupee and see where that is, because, that went to 91.94. If you can have the rate up briefly because I think they've got one eye on the dollar rupee, of course, as well. So 91.75, there's about a 10 paisa appreciation in the rupee. Remember, dollar has been extremely weak against majors, against emerging market Asian currencies over the last 24 hours. So I think there is that. And again, like the Nifty, stark underperformance, rupee stark underperformance against EM Asia, FX, etc. Gold and silver is what I was coming to, Dheeraj. You think there's a chance, I mean, again, with an eye on the currency, some are saying, well, you know, an import duty hike is already is in the price in that sense. You think possible?
Yeah, it's quite possible that the government will do something about it because despite fall in volume of gold and silver imports because of the prices, in dollar terms, it's actually significantly higher, right? And it's reaching a level where it puts pressure on our current account deficit, it puts pressure on the currency. So one could expect some measures by the government to sort of soften the gold and silver demand domestically.
It's possible, right? Basically just to preserve dollars in that sense. I mean, to...
I think in absolute sense, the price of gold and silver is not really government's concern. I mean, like the price of equities.
No. It's about. I mean, the point is to curb demand and outflow of dollars. That's why
right.
I said.
That's right. So primary concern is currencies. If you remember, even in 2017, under Chidambaram, the government had done some very aggressive measures to control the gold imports.
Yeah.
If you recall, 2013, in a span of just 6 months, rupee had lost 40%.
Yeah.
So this slide of rupee is actually slower than that, but it's still worrying.
Yeah.
So one can expect some action from the government on that front.
Dheeraj, we'll leave it there. Thank you very much for joining us. Good speaking with you. Always a pleasure. Reema, I think we have the Sona BLW management with us.
Yes, and they reported a good set of Q3 numbers. Numbers were largely led by tractor, motors and the railway business. And the company is guiding for margins between 24 to 25%. We have with us Vivek Vikram Singh, Managing Director and Group CEO at Sona BLW. Vivek, thank you very much for joining in. This is Reema here. Let me begin with the India-EU FTA that's expected to be signed today. Europe is approximately 16% of your overall revenues, which is lower than 25%, which it was last year. If the FTA comes through, how does it impact your business? Could you put it in numbers and your own expectations?
Good morning, Reema. The FTA would be a positive. We have a fairly strong pipeline of inquiries from the EU. A lot of European OEMs and European tier 1s are very interested in resourcing to India. I think it's not just because of the FTA, it is also because there is structural weakness in European tier 1, tier 2 smaller suppliers. A lot of them are going, I'd say, they're in financial difficulties. And because of that, there is a strong and urgent need to resource from other countries and from capable suppliers who do not carry the same financial risk. So, yeah, I mean, it will be another positive in a way to diversify away from the US and get more EU business.
Okay, but the main reason for the optimism surrounding EU is opportunities driven by the financial distress at some of the smaller OEMs.
A lot of our direct competitors, actually, 3 direct competitors have filed for insolvency in the last 6 months. So all of this geopolitical uncertainty, etc., has been obviously very, very bad for weaker players. As I always say, that we have this hypothesis of anti-fragility. There are companies with strong balance sheets, with strong capability, who tend to gain in periods of disruption. This happened to us during COVID. After COVID, we saw a lot of Asian suppliers go under, and we benefited from that.
Okay.
Similarly, a similar theme is playing out right now. I guess what we are seeing for our sector, I think it will be playing out for other auto component as well as engineering good people also.
Okay. So you're saying 3 of your direct competitors are under pressure, filed for insolvency. What does this mean in terms of growth for you coming in? And are these all European OEMs? What does it mean for growth coming in from Europe? And tell us a little bit more about the visibility in the North America business, given the tariffs.
Yeah, so North America business hasn't really grown. There is uncertainty, but the way our contracts and the kind of parts we do are mission critical parts, so they're not that easy to replace. The replacement cycle is very long. And second thing, what the US has done, so obviously you know that there are two kinds of tariffs, Section 232 tariffs, which are sectoral tariffs, and then there are the country tariffs. Auto components, a majority of light vehicle components come under the sectoral tariffs. They are still under the old 25% regime. So there is no difference if you're from India or any other place. It's 25% for everyone. In that case, you are basically as competitive as you used to be. The only downside we see is the demand in the US market is weaker than it used to be. That's about it. So what we have done is we have grown tremendously. I mean, this quarter was almost 40% growth, right? US has not kept up with 40% growth, so other segments have grown and India has grown for us, and hopefully Europe will grow in the future. So that's where it is. It seems to be all working out, to be honest, where we stand.
Yeah, no, Vivek, hi, morning, Prashant here. You know, the other slightly bigger picture, right? But you heard that speech from Germany's MERS. I don't know if you saw it, right? They're looking to start to spend. They want to spend and they want to do some things they've not done for many years, right? So pendulum was on one end, and when the pendulum starts moving, it really just stops at equilibrium, right? It goes. Let's see if that is the case.
Always.
Yeah.
So I hope so, Prashant. I mean, reindustrialization of Germany and Europe at large will be actually very good for the entire world economy. If you look at the last 10 years, the European car market or car production has been only going one way, which is down. So if they start spending, if they put money in CapEx, that is good news for all kinds of suppliers. And obviously, being from India, we are probably in the best place we could be in the world right now.
Yeah, absolutely. I wish you would join us for a longer conversation outside of the quarterly numbers, Vivek, and we'll invite you. Thank you very much for joining us, though, at this point in time. Really appreciate it. Well, I think we're talking about steel now, and JSW Steel is in focus. Nigel, take it away.
Well, that's right. JSW Steel is the next management on our radar. The quarter three numbers more or less in line, but that was predominantly because of pressure in pricing in the past quarter. The way ahead could look better. Let's welcome on the show Mr. Jayant Acharya, who's joining us. Hi, Mr. Acharya. Good morning and good to see you in. Let's start with the focus on demand. How is steel demand panning out in India as well as globally? And could you help us out? What could it mean for your volume growth from here on, sir?
Yeah, I think if you look at the global economic outlook by IMF, it outlines the fact that the global economy has been very resilient in spite of various uncertainties globally which we are facing. The steel demand, I think, in the rest of the world is doing reasonably okay. The steel demand in China, as we are aware, has been under strain. India, from a steel demand perspective, is the fastest growing, as well as the economy is the fastest growing. So India is doing quite well. We see the current coming quarter four, to be seasonally strong from a demand standpoint, and we are well placed to take advantage of the demand in India.
Okay, demand in India is sounding quite optimistic. And to be fair, the central government as well has given a good amount of assistance because duties have been put in place to protect the domestic steel industry, post which there have been price increases. Help us, Mr. Acharya, quantify these hikes, and is there headroom for further hikes even from here on?
Yes, so if you look at it, yes, I think we are thankful to the government of India for having taken effective trade measures in the last 2 months, both from anti-dumping point of view and safeguard on flat products. I think that's been very encouraging. The idea is to ensure that fair trade happens in India and the domestic industry is at a level playing field. From a price standpoint, I think I would just like to, if you look back, I think the prices which were there in the last quarter have been at a multi-year low. The prices have now started recovering. We see price increases in the month of January, and we think there is a possibility for some price recovery in this quarter during February and March as well. We'll watch how it goes, but from a raw material standpoint, the costs are also going up. I think part of the price movement is also on account of cost. You see coal prices, which have gone up from the lows of about 180s to now to more than 240 and touching 250 yesterday FOB Australia. That will have a impact on cost, and we need to look at the iron ore side. While it has been range bound, and we do expect it to be range bound, but that's another cost area which we need to watch and see whether it impacts us in this quarter or not. Otherwise, from a margin perspective, I think this prices should enable us to improve our margins after offsetting some of the costs.
Mr. Acharya, apologies, but I need to push you a little bit more. Quantify the steel price increases that you're talking about. And also, since you mentioned that coal costs have moved up a little bit, can you quantify what is the cost of coal increase that you are working with for the coming quarter?
Yes, so from a price point of view, the prices started, if I take hot rolled as an example of flat products, the prices started moving from the second half of December. And I think we saw an increase of about 1,500 rupees in December and about 2,000 rupees in the beginning of January. If you look at the coking coal cost in the last quarter, the coking coal cost went up by about $5, and we had guided between $3 to $5. And that's where we have been. Iron ore has been range bound. Actually, we could save a little bit on the iron ore cost by improvement in our efficiencies and blend. So with that, we were able to offset some of the costs, but still the lower prices had an impact on the margin and the EBITDA. I think our main, I would say, achievement for the past quarter is the volume story. We had a very good production, maintaining 93% capacity utilization, excluding our BF3, which is under shutdown at Vijayanagar for capacity augmentation. We have been able to do record sales in the quarter one, both from console and Indian operations point of view. And basically, we have been able to, I would say, that mitigate the impact of the drop in prices through a better product mix. Our value-added sales reached the highest ever at 4.54 million tons.
All right, Mr. Acharya, so what works in your favor is operating leverage, the focus on value-added sales, and also steel prices have moved up by 3,500 rupees. But the other part of the puzzle will be the coking coal cost, right? Since we have seen globally prices have moved up. For you, how much will prices move up by, the cost of coking coal?
In the quarter four, as I was mentioning, the coking coal prices are moving because of some seasonal disturbances in Australia. We expect in the range of $15 to $20 impact in this quarter.
Okay, got that. Let's focus on the globe then, Mr. Acharya. The global scenario has become very, very volatile due to President Trump. Could you tell us how is the markets doing, the United States as well as the European operations? How do you expect it to pan out in the coming quarter?
So U.S. operations have declared a positive EBITDA, and so has the Italian operations. If you look at a 9-month number, I think U.S. has turned from a negative $32 million to a positive $36 million. So that's a good thing. U.S., we have taken a shutdown, which is right now in progress for augmentation of some vacuum degassing facilities and caster upgradation in Ohio. That would enable us to produce more value-added steel. Italy is doing reasonably stable. They will continue to do a similar kind of a performance, I think, in quarter four, as we see. U.S. operations should marginally improve in quarter four versus quarter three.
Italian operations stable, U.S. operations could improve in quarter four. Got that. What about the progress with regard to that big deal you announced with JFE? Give us some timelines. How do you see things panning out?
Yeah, so this asset, BPSL asset, we are getting into a joint venture both together, and JFE brings in their technological expertise to India. We hope to add value-added products which are not produced in India. And with our expertise on project execution and operational cost efficiencies, I think it will be a very strong value which both partners can create. The asset has potential to grow from the current 4.5 million tons to 10 and beyond. This what should I say, unlock of value will help us to grow both the BPSL asset and the JSW steel expansions parallelly. And, that will be growth accretive for the JSW shareholders and stakeholders at large.
All right. Mr. Acharya, y'all have been focusing a lot on the organic growth side, and y'all have already said you'll be more than 50 million tons odd. But y'all have mentioned a line on inorganic growth. Is there something on the inorganic growth front that you're looking at, or is it mostly going to be organic?
No, nothing on the anvil as such. I think that's something which is general. We continue to look for any assets which make strategic sense. If any would come up, we would look at it.
The next obvious question would be, what about the net debt outlook? It's ballpark around 80,000 crores odd, but you have ambitious growth plans. Where is that headed?
So our net debt ratios is something which I would draw your attention to. Net debt to EBITDA has come down to 2.91. And we have been consistently improving the net debt to EBITDA over the last few quarters. And we are keeping our eyes on that as we grow our capacities. We have been able to reduce our weighted average interest rate to 6.51% from 6.67% last quarter. This is one area where we are actively working to see that we reduce our cost of interest. So good on the debt side. And this will go down naturally with the unlock of value from BPSL once the transaction is consummated in two phases, partly in March and partly by June.
Well, always a pleasure speaking to you, Mr. Acharya. Sounding optimistic on demand. Prices have moved up around 3,500 rupees. Input costs, though, have spiked up, though the price hikes and operating leverage will more than offset the higher input costs. Thanks a lot for joining in. Well, that JSW Steel stock up 2.5%, but you need to keep an eye out on the market. A big recovery is what we have seen. The Nifty, the bulls are coming in there and protecting that 24,900 mark, which is heartening. Multiple times in the last few days, we're going closer to that mark, and that appears to be the buying zone. And, seen a good recovery. And the broader markets, that's more encouraging, because when we started off, only 700 stocks advancing. That number's moved to around 1,300 stocks odd. So good to see.
I think, Nigel, what perhaps would have happened is that all the pain in the system, right, after Friday's very, very sharp sell-off, the forced squaring, both on the leveraged cash side, which is MTF and others, on the F&O side, I think all of that would have happened in the first one and a half. Actually, I would typically, you'd see a turn like this after a very bad day by 11:30, 12, as I was saying earlier, and maybe that is now kind of sort of out of the system and a better sort of cleaner kind of a roadmap in that sense. So there was pain across brokers and on the margin side, margin position, etc. So I think that is now, in a way, behind, at least for the day. So let's see if we are able to hold gains. There's a very, very light market in terms of longs. And in terms of short positions, especially in the F&O side, FPIs are short record levels on index futures. So, and there is this big event on the which is the budget, which is not talked about at all, no expectations. So there is that element as well. Would you want to go in with that kind of very, very large positioning, or maybe cover up a little bit over the next 4 odd trading sessions? That's also an important element in the very near term, which I think will play out. 100 points, which basically means in the last, and we've been trading for how long? I think 45, not even 45 minutes. So we've swung 250 odd points, 70 odd point move lowers. 70 point move up immediately, 70 point sell off, and now a 100 point move higher is what you have. So it's been volatile. We'll take a break. We are back. Granules India management with their third quarter performance and some outlook on the other side.
Welcome back. Now let's invite the management of Granules India. They reported a strong set of Q3 numbers. The top line growth was at 22%. Margins were healthy. We have with us Priyanka Chigurupati, Executive Director, Granules India, on the show now. Thank you very much for joining in. This is Rima here. So Q3 was strong, top line growth of 22%. For 9 months, your top line is at 18%, EBITDA margins at 21%. Now, 9-month performance is ahead of your earlier guidance of mid-teens revenue growth. What are you likely to end FY26 with in terms of a top line and margin performance?
Good morning, everybody. Thanks for having me. Yes, certainly we had a good quarter. We had a YOY increase of 22% in revenue and about a 28% increase in PAT. And if you set aside our acquisition loss, our growth in PAT has been about 45%. So we've certainly had a very good quarter. Going forward, we are still in the process of remediation, for the warning letter remediation. So depending on that, we should see the next couple of quarters roll in. But we do expect a very positive outlook for Q4 because a lot of the remediation activities have gone up and our capacity utilization is finally going up.
Okay, so expect a positive Q4. On this remediation, you said a post-warning letter meeting was held with the US FDA in early January 2026 on the Gagillapur. What is the next step? When do you expect it? A full and final closure on that?
So we had a good meeting with the FDA. We had a constructive conversation with the FDA. They asked us to send in some documentation, which we have sent in, and we're continuously in correspondence with them. So in terms of the outlook, it really depends on what the FDA thinks of our remediation activities. And if they want, they can come as soon as tomorrow or a few months down the lane. But we do expect them to come for a review before we move forward. But that said, I continue to say that our existing products, we haven't seen any dip in performance. We continue to gain share in most of the products that we already have approved. Right now, it's only the products that are still pending approval that are stuck with the FDA.
Priyanka, good morning. Just one thing, you said Q4, of course, is looking much stronger. Can I take the timeline a little forward? If you want to put out some numbers for what you think FY27 will look like? I mean, what is the aspiration internally?
Look, I would love to give you some guidance, even internal aspirational guidance. But like I said, a lot of it has to do with the FDA remediation. If they come in as soon as tomorrow and do a remediation, give us a clear chit, we have about 10 to 13 approvals that are still pending. So launching all those products is going to be a big win for us. So you could see the numbers go up significantly over the next in FY27. But again, at this point, it depends on the GTP remediation activities.
Okay, all right. Hi, Priyanka. Good to see you. And let's talk about a couple of other factors then. Earlier, you all were guiding that the net debt number comes down by around 10 to around 15%. Do you stick to that guidance? And in that sort of a backdrop, could you tell us, you had approved raising close to 1,700 crores. Break it up for us. What will this be used for?
I'm sorry, can you just repeat your question? You cut off.
The debt number you all had guided earlier, that would come down by around 10 to around 15%.
Yes.
So do you stick to that? And also you all have approved, raising some money, 1,700 crores. Yes. So break it up for us. What would this money be used for?
Well, right now, the money that we're raising through the warrants issue and the primary infusion is primarily to strengthen our balance sheet. Because we are looking at some potential opportunities, inorganic opportunities. Nothing concrete yet, but if you look at our portfolio evolution and our strategy evolution over the last couple of quarters and last couple of years, it's been playing out really well, where the percentage of what we call our integrated generics versus complex generics has gone down. So the complex version has gone up, which means that our strategy of our ADHD control substance strategy, our oncology strategy, our complex product strategy has been playing out pretty well. So we are looking at growth within the complex generics range, and that's why we want to strengthen our balance sheet in case a great opportunity comes our way.
Okay, so the fundraise is not to accelerate deleveraging, but rather to look at inorganic opportunities in complex generics.
I just want to correct that. It is to strengthen the balance sheet. So we do want to get rid of some of the debt and that way strengthen it if an opportunity comes up going.
What is the debt deleveraging target by FY27? Is there a number?
We always want to have our net debt EBITDA ratio below 1. I think that's a comfortable level.
Priyanka, but it's quite interesting with regard to this inorganic opportunity that you're looking at. Do you think that the next couple of quarters in the first half of next fiscal, we could hear something? And what's the company's appetite in terms of, how big do you all want to buy it? What could the acquisition size be, since you're looking at a few?
Well, see, right now we're looking at multiple, right? But we're not going to do anything that is outside of the focus of, very strict focus of what we're doing right now, which is the complex generics area. But we are being very prudent with our capital outlay because we already have our Sen acquisition that happened that still has to play out. So considering that, considering our a net debt EBITDA, I guess the prudency over there, we would like to limit the spend. We won't do something that's outside of a comfortable balance sheet level.
So complex generics, I believe, is now 49% of finished dosage revenue?
Correct.
So without an acquisition, considering that is a focus area, it's growing well, what will that contribution go up to? And if you do an acquisition, till what level are you comfortable with?
Right now, yeah, if you see the integrated has been about 47 to 50 range, and 49 has been complex generics. And complex, we break it down into 3 to 4 segments, one of which is oncology and controlled. And like I said, extended release, modified release products that also contributes to complex generics. So we expect that to significantly grow over the next 2 years. And we just got 2 approvals. We've announced that in 2 tentative approvals that we've announced over the last 2 quarters. In Q3, we got an approval for tentative approval for generic Adzenys, which is again for treatment of ADHD. That's a limited competition product with an addressable market share of about $170 million. And we also got approval for another product, tentative approval for generic Dynevel, through which we're eligible for a potential first to file opportunity. And that has an addressable share of 41. So the number of organic R&D filings in complex itself are going to go up quite significantly with a good target for this year and the upcoming year. And the oncology side of things haven't even started yet. So all the filings are happening. We'll see them happening from next year onwards. So you'll see a significant increase in the contribution of complex generics as a percentage of whole.
All right, Priyanka, let's focus on a smaller part of your business, the peptide slash CDMO business. Currently, it's doing a quarterly run rate of around 32 crores. How do you see this number scale up? If you want to give us a quarterly number on an annual basis, and also at when does it break even?
Well, I'll actually answer the second point of your question first. We, in our last investor call and in this investor call, we mentioned that we expected to break even in Q4, if you look at it on a quarterly basis. But this business is, like you can imagine, a CDMO business has its ups and downs, right? It's not it's not a straight up growth in terms of trajectory. So we do expect this year to close at a decent level with a break even. And our strategy right now is to focus on AEDs and fragments, and also a part of the cosmetic industry. But the long-term growth is in complex fragments converted to API. So it depends on how quickly we're able to use our existing relationship with innovators and make our pathway through to them. And that'll determine how quickly we grow in this business.
Okay, so break even in Q4 FY26. Thank you very much, Priyanka, for joining in. There's a word coming in on granules. Time for a break. On the other side, we'll talk about this intraday recovery that we've seen in the markets. Chandan Taparia, Motilal Oswal Financial Services will join in with his technical view.
Chandan is with us. Welcome back to take stock of where we are as far as the market is concerned. We are up 85 points on the Nifty, 25,136. Chandan Taparia of Motilal Oswal Financial Services with us. Chandan, good morning. Good to have you with us here. I suspect a lot of forced selling and margin squaring, etc., has happened in the first nearly not even an hour of trade. Do you think this is remnants? The initial volatility was remnants of the very large selling we saw on Friday. After effects of that, and maybe a little cleaner now in terms of positioning. What's your sense?
Yeah, good morning, Prashant. Thanks for having me. So the important part is that we have seen a spurt in VIX, which spiked by 8 to 9% for the day and up by more than 60% in last 16 days. VIX has rallied well from 8.7 to now 16 marks. There are multiple reasons for higher VIX. First, the CBOE VIX is also at higher level. We have union budget, and the market structure with some fear in the market. So I believe the extreme level of VIX is also the reversal sign. But as of now, the structure of the market is negative and it has been making lower top, lower bottom formation. Market witnessed some recovery, but only question is that every recovery is being sold. If I look at the price behavior of last 14 days. So looking at the data setup, I believe the major support for index will be near 24,800 to 24,650, which is 20-month moving average and working well from last 5-year post 2020. So as of now, I believe upside seems to be kept. Volatility could be there because of the higher VIX, but those who are looking for bargain buying or bottom fishing can closely look at the key level at 24,650 to 24,800. On upside, if it goes about 25,450, then only the stability will be back in the market. So we have to play the wider range as countdown for the budget is there, and I believe negative bias will be there, but market has potential to bottom out near 24,650 to 24,800, given the multiple cluster of the scenario or multiple cluster of the evidence from the mechanical indicator in the market.
Got that. So markets can bottom around 24,650 to 24,800. What about stocks, Chandan?
Yeah, so again, advanced decline ratio for the market is negative if I look at the weekly data setup. But yes, couple of counters are there, and I think this is the time for the bottom-up picking rather than talking about the sectorial fund. First, it is buy on APL Apollo. This is one of the strongest counter which really done well, holding well above its 50-day exponential moving average, making higher top, higher bottom on the monthly chart. Major trend of the counter is positive even after the corrective move of Nifty by more than 1,500 points. This stock is really holding well. So positive momentum cannot be ruled out. One can buy with support of 2020, and here this counter can head towards 2170 kind of level. Second trading area, that is buy on Ultratech Cement. Again, higher base is clearly visible. The formation of higher tops, higher bottom with the rounding formation on the weekly chart indicate bullish bias in the counter. One can buy with support of 12,200 and it can head towards 13,400 level. One selling idea, that is sell on Lodha. Nifty real estate is one of the weakest structure in the sectorial fund, which has been making lower top, lower bottom. Most of the realty counter are looking weak with built up of short position with sustained call writing. So Lodha is one counter which looks weak. One can sell on a small bounce with hurdle at 900 and it can go down to 820 marks.
Thank you very much for that. The Nifty Realty Index opened with a cut of 1.5%, now down half. But since the start of the year, the index has lost nearly 15%. But let's talk about the biggest Nifty gainer and the biggest Nifty loser. You've got Axis Bank and Kotak Mahindra Bank on both sides of the spectrum. Gaurav is here with his analysis. Gaurav?
Well, yes. First, let's talk about the gainer, which is Axis Bank. If you look at the numbers were actually better than the street's expectation. So net interest income increased almost by 5%. OPEX, if you look at that number, it was well contained. That grew just by 7%. And as a result, if you look at pre-provisional operating profit, we saw a growth of 3%. And the same followed in profit as well, where we saw 3% growth. Now, the number may look a bit small, but it is higher than the street's expectation. What else actually came as a positive surprise is first is credit cost. If you look at the provisions number, that declined sequentially, and as a result, calculated credit costs that declined almost by 50 basis points on a sequential basis. Even if you look at slippages, they also remained stable. In fact, the management commentary, that also remained very positive. They said that they will be growing 300 basis points higher than the industry going ahead. And at the same time, slippages, they are very confident that the technical slippages that they have booked, there won't be any losses even in the times going ahead. Net interest margins, if you look at that number, that declined by 9 basis points, but it was in line with the street's expectation. So all in all, numbers were good. In fact, the core performance was actually better, and that is the reason why Citi upgraded the stock. And at the same time, Nomura also said that on a valuation front, Axis looks at a very reasonable price, and that is the reason the stock actually remained their top pick. On the flip side, if you look at Kotak Mahindra Bank, now if you look at the numbers, profit was a bit lower than the street's expectation, and the key reason was there was a one-off in the employee cost. Now, if you look at profit, that grew by 7%, but it was actually 3% lower than the street's expectation. Other than that, one positive side was that the credit cost, which declined, and at the same time, slippages also remained a bit stable. But on the flip side, net interest margins, now they remained stable on a sequential basis. It was a big negative for Kotak Mahindra Bank, given that street was actually expecting net interest margins to expand. Second is that on acquisition, now bank said that any M&A should fit financially, strategically, and be smooth to integrate. Now, what the market is reading is that Jeffrey says that the management commentary suggests lower probability of IDBI deal, which is a speculated deal in the bank, but at the same time, valuation is one of the hurdles for Kotak Mahindra Bank. If you look at the numbers were fairly more or less in line. with PAT actually a bit lower than the street's expectation, but valuation is still at a higher end, and that is the reason why Investec said that if you look at the ROE profile, which is at 12%, and given the valuation, there is limited upside to the stock, and that is the reason they also maintain their hold rating. As a result, we are seeing some kind of pressure on the Kotak Mahindra Bank. As we speak, the stock is down more than 3%.
Okay, all right. Thanks very much, Gaurav, for that. So that's private banks in focus. 50 points, by the way, on the Nifty. So there's a bit of a drop from the highs which has happened, but we're at around the 25,100 level. We'll take a break. We are back. Our special segment, Indianomics. Latha discusses capital gains taxation in the upcoming budget with experts. That's coming up. Very interesting chat in just a bit.